Everything's good? All right. Again, appreciate coming back. I've spoke to some of you probably a few times now. Some of you, this might be the first time you've heard me, but anyway, commodity marketing company. We work with UFC. We help them in some corn things, a lot of things, natural gas, other things as well. We also work with ethanol plants. We provide risk management for ethanol plants. We work with individual farmers. We do risk assessments for producers. We do consultations. We do plant study. We do a variety of things. So we're based out of southern Minnesota in Albert Lea, Minnesota. We've been in business since 1997. And again, we've basically, trade corn, trade soybeans, both from, I would say, a risk perspective or hedging perspective, and also from a speculative perspective at times, based on who we're working with. So we tend to analyze things from all directions. And again, like Brett said, if there's anything you want to discuss or ask questions about, feel free to stop me and we can look at some of this. So I want to look at both corn and soybeans today. And focus primarily on new crop. We can talk old crop as well and some of the things that we see there. But with that, we'll start with corn. Obviously Friday, not a great day, right, for us who are producers or unsold, if you will, or hoping for that old crop rally to price some stuff. We got the March planting report. Acreage came out at 92.8 million acres, 92.8. The average trade guess going into the report was 91.3. So it was substantially higher than the average guess. The Gov came out in February at their Ag Outlook Forum in Washington, D.C. at 92 million acres. If you were to ask me, I don't think I saw an estimate north of 92. So Informa, some of you guys may have heard of Informa. Economics, they were at 91.8. So again, most people were 91.5 to 91.8. And the reason is that if you looked at the economics and the soybean corn ratio for November soybeans versus December corn, that ratio for most of the winter was between 2.35 and 2.4. And traditionally speaking, from a trader's perspective, anytime you're 2.4 or above, the economics are sort of shifting to soybeans, if you will, from a pure board perspective. And again, that doesn't include basis. It differs regionally based on where you're at and the basis you can get. But technically speaking, the assumption is that we weren't going to gain as many corn acres as we originally thought. And so when they came out at 92.8, we had a very negative reaction, and that's why corn closed down 17 cents that day. So obviously, what do we do with the board now, and will it come back? Those are some of the questions that I'm getting. Here's some takeaways that I see from the report, okay? As I said, it was about 1.5 million acres above the average trade guess, 800,000 acres above the Feb Ag Outlook number. The one thing that I would note is if you look at where we're going to add these acres, 1.6 million of the acres that we're going to add versus a year ago, North and South Dakota. Okay, so 44% of the anticipated acreage increase this year is going to come in those two states. Why is that important? North and South Dakota, love them, right? Love the Dakotas. My mom's from North Dakota. I got nothing against the Dakotas, but they don't yield as well as Minnesota, Iowa, Nebraska, Illinois, Indiana, Ohio. Take your state. So when you add acres in those states, it's not going to pull the national corn yield up. So when I look at it, I say, okay, if you're going to add the acres, you can't necessarily pull the national trend line yield up as well. Okay, you can't have it both ways unless you're going to add all those acres in Illinois, Iowa, and Minnesota. So states like that. So I don't think it's as negative long term as kind of the original impression was when we got the number on Friday. So keep that in mind. I would also say, and you're hearing a lot about this right now, is preventive planting. North Dakota and South Dakota are numbers 1 and 2 for prevent planting. So again, will we get all these extra acres? We do know this year we had a lot of snow, right? You guys are reading about it right now. There's parts of Iowa, eastern Nebraska underwater. We've had issues with a number of ethanol plants and rail logistics being screwed up for quite a while because of the high water. That's going to be an issue on the Red River this year. In North Dakota, we know how that tends to flood every year. So again, this is also one of those years where I think you're going to see that come into play. So when you look at the acreage increase, again, I wouldn't overreact to the negativity or the initial market response that we saw on Friday, because I think once people start to digest more of this, they'll start to generate a different opinion over time. The one thing I will say too is people tend to look at, okay, how accurate is the March number? Okay, over the last 10 years, we've had 5 increases from March to final. And again, you get your final acreage number in January, right? So at the end of June, they're going to revise it again. Okay, June 29th, they'll revise it again. Then at the end of January, we get the final. Over the last 10 years, there's been 5 increases from March to final. Okay, the average increase, 900,000 acres. That's pretty accurate. They're actually pretty accurate. Versus 5 decreases. So it's 50-50 based on this number. Okay, and the average decrease, 1 million acres. The largest decrease was almost 2 million acres in 2013. So again, could this number come down a million and a half? Absolutely, absolutely. And I'm leaning more towards a number under 92 million when it's all said and done. Or we're going to stay at 92.8, and I think the harvested acreage number, where it traditionally is about minus 7.4 million acres versus your planted number, I could see it being 8 million this year, or 8.2, just because of the idea that prevent planting is going to be larger than it has been in the past. So you still get that harvested number, which ultimately is the one you want, kind of to that level that I'm anticipating. So those are my takeaways again, and I'm bullish corn. I'm a little, you're going to love hearing that, but I still am. So I'm talking my position a little bit here, but I do think these are important takeaways. And here you can see, guys, just the change in acreage from March to final over the last 10 years. And you can see there, 2013, the largest decrease, 1.92 million. The largest increase, 1.43 million, which is in 2012, which again, we were adding acres in a year where we didn't get much anyway. So, but you can see some of the volatility March versus final. It is pretty amazing, though, that the number, I mean, even if you look at that, a million acres feels like a lot, but it's like a 1% skew. So, you know, in this report, they survey over 82,000 farm operators. So, I mean, they do get a pretty wide response, you know, from a number of producers. You know, the next question is yield. I mentioned earlier, if you add acres, you can't always add yield because it depends where you're getting the extra acres. If you look at the 3-year average yield, okay, and I always focus on the top 12 states, the 3-year average is 175.9. It's just insane, right? We've had like 4 or 5 years now of record or near record yields. We haven't had that weather scenario where we've had not necessarily even a 2012, but even a 2013 where we had a 155 or something like that. So we've had an unprecedented run of record to near record corn yields. This is the largest planted acreage base now at 92.8 since 2016-17, when we had 94 million acres. That year, the final yield was 174.6. So if everything goes well on 92.8, you can probably still get something close to 175, but I think it eliminates this idea that we can be 178, 177, something up there. So something to keep in mind when you're looking kind of building a potential supply and demand sheet for 2019, 2020. That being said, what does the S&D look like in my opinion? Why does this matter? So in May, the Gov comes out with their first 2019-2020 S&D. Okay, that's the first time we're going to see an official WASD report with the 1920 numbers. Okay, if you use the March intentions figure 92.8, a yield of 176, that's considered trend line right now. And if you saw the 3-year average 175.9, that's where they're getting that. Carrying stocks of 1835. The demand number at 15.015 billion bushels, that's from the February Ag Outlook estimates that we got, okay, in February from the USDA. So all I'm doing is I'm using that demand estimate. If you take all of that, you get a carryout of 1889, okay, for 2019, 2020. So, and a stocks-to-use ratio of 12.6%. You know, a couple things there. You know, we've come out of 3 crop years where early in the marketing year, we had carryout projections of 2.1 to 2.2 to 2.3 billion bushels. So 1889 doesn't feel as big as it maybe did 5 to 7 years ago. So again, in my opinion too, that's even a little bit mildly constructive, especially when you consider it's going to take a 176 yield to get 1889. Okay, so I'm not as negative that as some people might be. Again, just based on historical precedent and what that might have meant 5 to 7 years ago. What I will say, and this is what I like to do, is stress the model a little bit. If you reduce the acreage number a million acres, which again is the average acreage decrease in those 5 years that we decreased over the last 10, take it to 91.8, you lower the yield to 174, okay? Just a slight skew below trend, which again, it's incredible, but 174 would be slightly below trend. You keep demand consistent, your carryout drops to 1544, okay, or a stocks-to-use ratio of 10.3%. So, go ahead.
Yep.
You do, but my guess is they're not going to change that in the April report. We've seen aberrations. I think what's that? May's the big one, and when they're gonna, and what they'll do too is some of that's feed and residual use, too, and some of that it's hard to back into. So until you get to the SEP1 stocks number, I just let it work a little bit. But you're right, and that's the other thing is the other thing I'll say about stocks though, and I just ran this chart yesterday, is they were still about 300 million below last year for for March 1. So. And you can see where this year's carryout's at 835. So I'm just going to give it some time. What's that? Yeah. Yep. Right. Exactly. Yeah. We know a lot of guys like that too. So, yeah. So we'll see where that number goes. But that's why I tend to wait on the March 1 stocks. I don't overreact to that until we get to later on in the marketing year. So we'll continue to assess that. Ending stocks, again, just point of emphasis, where are we? 1835, the 5-year average is 1947. So again, slightly below the 5-year. And 1889, again, is what the forecast shows, okay, based on what we know today for 2019, 2020. So again, slightly below the 5-year average. Again, if you were to ask me, did the acreage number hurt the bullish argument? Absolutely, a little bit. I mean, it was a kick to me. I was not expecting 92.8. I'll always shoot you straight. I was hoping for 91.8 or 91.5 or something like that. So it definitely makes it a little bit harder as you get into the early spring and summer. But again, I'm going to show you some charts here where I don't think there's a reason to be scared or nervous yet that we've missed the opportunity or it's not going to get any better. So. Keep that in mind. Stocks to use ratio, this is becoming more and more important, right? Because, again, historically speaking, 1,800 million bushel carryout 10 to 12 years ago might have meant a stocks to use ratio of, 15, 17%. Nowadays, it's, 12.4%, 12.6% because we're using more corn. So the stocks to use ratio, you can see, has come down over the last couple of years. And again, I'll show you charts, but in 2016, these corn went to 449 during the month of June. With a stocks to use ratio of 15.7%. So again, I think the important key here is that the stocks to use ratio is tightening. Okay, it's not as wide as it used to be, and it's at least showing the opportunity. At the end of the day, you need some fear of a yield aberration or something like that, but it's getting better and it's working in your favor. Now, here's where I'm going to kind of hedge a little bit on that. Because I like the supply side of it, because of the fact that it doesn't take much of a yield variation to really change the scope. The question is, can we keep the demand base where it's at 15 billion bushels approximately? And that's the question, is you're not going to rally corn and have no impact on exports, okay? And the problem is, if you look at the USDA's Ag Outlook estimates for corn exports for 1920, they're at 2.475 billion bushels. That'd be a record high, okay? We've already seen this year's export number come down over the last 2 months. Why is that? Brazil and Argentina's crops have recovered this year, okay? And they're going to start to chew into the strong export pace in corn that we've had for really the last 12 months. And you can see that right here. So they're forecasting 2.475 billion bushels in exports next year, okay? Up 100 million from this year. And yet, as we can see right now in 2017-18, okay, Brazil and Argentina exported 45.7 million metric tons. This year, they're forecasted to export 59. Okay, so up 13.3 million metric tons. Okay, that's a big increase. That's like another 600 million bushels. So it's going to be a tough sell to say that we're going to export even more than we did this past year when they have all this extra corn available. And again, Brazil, Argentina, Ukraine, those are the other top 3 corn exporters in the world other than the U.S. So again, that'll come into play. So I'm a little bit skeptical that number can stay at 2.475. So you might see that number come down a little bit in May, which again is going to neutralize some of the supply side variables. So something to keep in mind there. The other one, elephant in the room, if you're an investor in an ethanol plant, ethanol margins haven't been good. All right. They haven't been good really since August. So we work with a lot of ethanol plants. We have a wide scope of a lot of plants throughout the entire industry in the Midwest, in the Eastern Corn Belt, all over. Ethanol margins have essentially been negative on an industry average. Okay, so every ethanol plant's a little bit different. Obviously, your ethanol yield, is different for every plant. If you're 3 gallons per bushel of corn versus 2.8, it's a significant, influence on your net margin. But I would say in general, with the 2.9 type ethanol yield, most of these guys have been negative since August. Okay, and anytime you get below about 60 cents per bushel margin in the red, you're below variable operating margin. Okay, and negative 21 cents, negative 20 cents is considered EBITDA, cash EBITDA. So not only have we been negative, but we've been low 20 for a substantial amount of time, basically since October, really through April. And we've seen a slight improvement. That's backed off again. But not only have they been negative, but they've been burning cash. And again, what have we seen? We've seen ethanol stocks now in the last EIA report over 24 million barrels, record high, actually this last week. And again, some of that has to do with the river and logistics, but they're still record high. And then we've also seen finally the run rate from an industry standpoint drop under 1 million barrels per day, which has only happened 5 times in, I believe, the last 12 months. So the run rate for the industry last week was 975,000 barrels per day. And we've been as high as about 1.5 million barrels per day. So we've seen some demand destruction there because of the margin issues. And we're still seeing inventories rise. That's not a great scenario, right? You typically want to see, if you're going to slow down, that the inventories also come down and we start to bring this thing back into balance and the margin improves. And we haven't seen that yet, okay? So my only concern is the ethanol demand side of it. Right now they're forecasting next year's ethanol demand at 5.575 billion bushels, up 25 million from this year. We got to see that trend in ethanol demand continue. It's good for you guys. It's good for your basis, right? They pay up. They're consistent buyers, so they're always in the market. And they really create, a good regional market for you guys. They represent about 37.5% of total U.S. corn demand. So my one concern, again, is that you can look at the trend in U.S. corn ethanol demand since 2000, and you can see over the last 5 or 6 years, it's starting to go sideways. And really, if you look at the USDA's baseline projections through 2023, 2024, that number's still relatively static. It doesn't grow much. Okay, there's some linear growth. I mean, it's small. It's very small. But and part of that is just E10 and, politics and waivers and things like that are coming out. So it's very hard to know where this is going necessarily, but this is one, too, where I've got to just hedge a little bit because we got to have this demand longer term to offset, these 174, 175 national corn yields. So those would be the 2 demand side variables, exports and ethanol, that I would say lower my upside price objectives in December corn moving forward. Just because, again, above certain levels, you create demand destruction if you price yourself out of a market. And that's what we'll do as D's corn gets above 425, for example, or higher. So a couple of things to consider. Chart-wise, this is last year's chart, okay? Last year, okay, again, we went to 429.5. That was the year high, calendar year high, I should say, on 5/24, May 24th. We broke to 342.5 on 9/18. We had sort of this counter-seasonal sell-off. Again, typically your highs are in June or July. They really are, every year. And where it's sticky, and again, where guys say, well, I don't really need you because you tell me every year it's in June or July, I'll just wait till June or July. The reality is that sometimes it's on June 6th, sometimes it's on June 27th, sometimes it's July 13th, and then what happens immediately after you make that high, typically every summer, the market completely falls apart. So if you miss that window, if you miss that pricing opportunity or the timing of that window, you typically don't get a second chance at life, right? And it crashes. So last year was super hard. It was a hard year to market, even for a guy that literally watches it every day, because you typically don't make your highs in May. What happened last year? In last half May, early June, the bean market collapsed, broke about $2.50 a bushel in 13 trading sessions. Corn followed, not penny for penny. But again, it was related to the tariff. The tariff went into effect on July 6th. We'll talk soybeans here in a minute, and I'll show you the timeline. And it just created a really difficult pricing scenario in corn because, again, I felt like corn was pulled lower because of soybeans, and it happened sooner than it normally does, so nobody was really prepared for it. The other thing that was hard last year when you're talking tariffs and things like that is you're always 1 week away from it changing, so it's like, you can trade all these S&E variables, you can trade the technicals, you can trade all this stuff. There's other outliers like currency and those things, way easier to try and anticipate than President Trump's Twitter account. I say that every time we come here, but that's the reality of it. Like, you don't know if he's going to make a deal, if he's not going to make a deal. We're seeing that right now, right, every day. Like, does anybody get Ag Resources or their market wire? You save your money, right? Anyway, every day, all they do is talk about China and their trade deal. And that's the thing is everybody's waiting for something to happen, and the reality is we never know. So like last week, the U.S. trade delegation met with China again. We're waiting for this big, announcement. Now it's supposed to be this week. You just don't know. And we've basically been doing that since May of 2018, every week waiting for the next reality series to come out as far as whether we're going to score a deal. So very hard to trade in that market. I would say for you guys, it hasn't been a positive, and I know a lot of us wanted we should stick it to China a little bit, we got to be even and all these things, but when you're a farmer and literally in soybeans, 60% of what you produce is exported to China, you guys took it on the chin harder than probably any other industry in the United States as far as, wearing some of the ramifications of what's happened. So I'll be one guy that's super happy when it's over, because what we need in corn and soybeans is just market transparency, where we don't have tariffs dictating who's buying or selling or the timing of when sales are made, things like that. So all of that made 18 incredibly difficult from last year's perspective. If I was to say what's my analog year, and every year I try to find an analog year, which is a year that I think looks very similar to the structure that we're seeing currently, I would say 2016-17. Okay, and one reason is the carrying stocks are similar. Okay, in 2016-17 we had carrying stocks of 1803. This year we're thinking 1835. In 2016-17, we had acreage of 93.6. It eventually went to 94 by January. This year, we're at 92.8. Okay, we started with a yield in 2016 of 168. Obviously, we're going to be higher. But what I like to point out here is that in 2016, okay, in the May WASDE report, we had an ending stocks forecast that year of 2.153 billion bushels. 2.153. That was in May, early May, and the market still rallied to 449 on June 17th. Okay. Now here's my disclaimer. I got a disclaimer at the end. It's big, it's bold, you can't miss my disclaimer. But my point is, I'm not saying it's going to go to 449. All I'm saying is that you can have stocks numbers like that, carry out figures like that, and the market will still find a reason to rally. It'll still find a reason to rally. And again, it doesn't take much to scare the market, and we'll get into a couple things that I think will scare the market here over the next really 30 to 45 days. So this is kind of what I see, and I've seen this for a while. Like I said, I would have preferred the 91 million acre view of this, but it is what it is. And like I said, even if you look at last year's number, we went to 429, 430 in May, and I'll show you some other numbers as well. But, again, I don't think a report on March 29th is the end of it for the entire year. We know that. So there'll be other opportunities. Current price action. This is my chart right now, okay? The bottom black line is the relative strength index. That's one thing I follow. Once you get to 20 on that line, the bottom line, it's oversold. 80's overbought, and you're kind of waiting for a reversal. We're kind of in the middle of that right now. You can see right at the end there, we had the big sell-off on Friday. Recovered a little bit yesterday. Today, I believe we were down a little bit. Interestingly enough, and this is why you got to look at the technicals, why do we stop at 84 1/4? The last major key low was 83 1/4 on September 19th, okay? So again, we didn't violate the parameters of the range that we've been in. Everybody's like freaking out about 17. We're still within the range of like what we've traded in. We're right to the bottom of it, okay? Now, if you close at or below that level, I'd have to reassess and say, okay, where are we going now? What's our new low? But as it stands, we're back up around 390 again in D's corn, and so at the end of the day, we've been 399 before the report. Now we're at 390. It's a 9 cent. I mean, we didn't really ruin anything, by virtue of the market. Now again, there's layers of resistance as we go above. The one area that's been giving us a bit of a headache is 402 to 404, And you can see that all the major highs really up through February are right in that level. And then if you want to look at the highs back to October, 407 and 3/4, okay? 406 and 3/4 in November, January, day high of 406. So, call it 406 by 386, okay? That's kind of your 20-cent range. We're okay, you know what I mean? And the market's still right where it's been really the last several years. So I'm not freaking out by anything at this point, again, based on what we experienced or saw on Friday. Here's the thing that I think will eventually change the market. And if you read my wires or any of that, you'll know that I'm a big managed money guy. Follow the money. I think the money doesn't lie. Money tells you where it's going for the most part. More than any wire you're going to read, anything I'm going to say. The money really dictates influences the direction of the market. And right now, as of a week ago, you had a record corn short, okay, in the corn market. So the black line with the arrows is 2019, okay? That's comparing the managed money position where it is today versus 2018, 2017, 2016, and 2015, okay? So the last 4 years, similar S&D, similar carryouts, okay, similar acreage, similar yields, all right? We have not only a record corn short, but we're also the most short corn. The money is the most short they've been, okay, in the last 4 years. With a tighter S&D, theoretically speaking. So when you look at 2018, last year, they were long 233,000 contracts in March. I mean, look at the skew. That's over a 450,000 contract divergence versus where they are now. And the problem with this is that if you're a corn bear, who's going to sell it right now? Who's coming in to sell it when you're already record short at 386 or 382 and nobody's going to sell it. Are you guys going to sell it on a break? No, you're not going to sell it on a 27. You got storage, you got space, you got time, right? You got all these things. There's no reason. So if the physical long in the market isn't going to sell it, which creates the commercial hedge paper to sell it, then who else is going to sell it? At some point, these guys are going to cover, and when they cover, okay, the only guys that's going to stop it from rallying 20, 30 cents is you when you decide you're going to start to price some of your old crop, and that'll chip away or stop some of the momentum back upward. But right now, I would say they're short close to 280,000 contracts. And again, that's, it's a record short. It's a huge short position. And again, typically, this is when they start to go long. Why do they go long in March, April, and May, and early June? That's your most uncertainty in the market. Okay, so they're always pricing in uncertainty. And then it goes the other way in July. And what happens to the market in July and in early August? Typically, it breaks. And what does the market do in May and June? It rallies. And what does the money do? It gets long. So if you can follow the money and the pattern of the money and the timing of the money, I'm literally saying it's within a week of when the managed money position peaks up or down that the market shifts the other way. Okay? And if you can time that window, you're going to be right about 9 years out of 10. So as it stands today, the money's super short. Okay, the market's kind of already done its thing. From a fundamental standpoint, I was talking to Anthony back there. We were like, what else can they throw at the market right now that's negative? I'm not sure. I think we played our bearish cards. And again, there's some variables there, but you've got a lot of weather and you've got a lot of corn to plant now. And now the point of emphasis is squarely on getting the crop in the ground, and it's all supply side stuff. And that's a better picture for the Corn Bowl moving forward. So I like this, and I would say that the money right now, if you're going to have one key takeaway right now, is vulnerable to an upward correction. Okay, upward correction. So keep an eye on that. The Commitment of Traders report comes out every Friday, and it's as of Tuesday's closes. So you have to do a little bit of math for Wednesday, Thursday, Friday, and make some assumptions, but you can kind of back into the number and where they're at. So December corn futures, this is just 2019 overlaid with 16, 17, and 18. And you can see the black line right now is 2019. The green line is 2016. The 2017 is the red line, and the blue line is 2018. So again, has D-scorn been lower in the last 3 years? Right now, yes, it has. In 2016, it went down and closed under 370, I think on 3 trading days during April. So could that happen? It's possible. Okay, it's another 10 or 12 cents. Does it stay there? No, it starts to come back, right? And again, the reason that I like to do this is it gives you some scope of what's my risk parameter, okay, going forward. Like, where should I get really nervous? Well, if it goes below 365, like we haven't seen that, right? So, okay, We also would say, though, if it gets to 370, what's historically speaking, does it go below 370, 375 in March, April, and May? No, it really doesn't. It doesn't stay there. All right, so you shouldn't freak out. Same thing as you get into May, June, and July. When you get over 410, 415, should I be thinking maybe I should sell something or get a little more aggressive, accelerate my sales? Probably. Okay, especially if I was to extend this chart, July, August, and September, what's after this? The market, again, typically comes back. And it goes back to those Feb, March lows. So, again, every year it's pretty similar. I will say what makes people good at their job in my situation is understanding, is that high coming in the beginning part of June or middle of June or first week of July? Because like I said, if you're an end of June guy and the high's on the 6th of June, you can easily see the market back up 50 cents the rest of the month. And you've missed your opportunity. The last time I was here, I think I showed you guys a chart where if you were to sell corn on average from January through the end of May, your average price would be higher than if you were to average your sales in June and July, which is insane because we always think June and July are the highs. The reality is the high and the low, there's extreme variance there. And when you average them, the average is actually lower than what you would have sold if you just sold it every day from January through the end of May. So gives you some idea of how to look at the structure of the market. 5-year seasonal, and again, this is just, it reinforces my view, really, of the last chart. But this is the 5-year seasonal, the green line, overlaid with current price action today. You can see that we typically, on March 28th, rally into the intentions report. It's not atypical that you break coming out of it, okay? And that's a function not only of acreage, but stocks as well. And then you typically rally into May. And this would say seasonally, your highs from a 5-year perspective are in the middle of June, okay? And then you can see that big correction thereafter. So I would use this and apply this not only to December corn, but also July corn futures, old crop, very similar. So, those are kind of the takeaways, as you look at and assess what's ahead in corn. In closing, again, I would say, like I said, the acreage number, tough one to swallow, at least momentarily. But I think there'll be better opportunities as we advance. I would say that the bigger question for you guys is what do you do when you get above 405, 410? I'm always a big fan of having, target market orders because the reality is, oftentimes, I showed you the closes here, right? But you can have spikes where, you open up at 415 and close at 403. I mean, a lot of that happens very often too, where you don't get that second look because, and again, it has to do with the money and the window and the pricing view of really kind of the macro traders, is that they'll assess the opportunity and they're all in at the same spot. So you could be up 15 and close down 2, and then what do? You know what I mean? If you have your target order in advance of the move, you don't have to be sitting there watching it, okay? Because you guys might be out in the field or whatever, and you still get hit. You still get your orders in, right? And so if I was in your shoes right now, I would look at this and look at some of the pricing opportunities that we've had, and I'd assess, okay, where do I want to sell my corn? What can I live with? And at the end of the day, too, you keep some of your powder dry, and you hope for, potentially, the type of move where you go to, 440 or 450, if we get that type of opportunity. But I wouldn't leave it all open. You know what I'm saying? Like, I would be somewhat aggressive. Again, just based on what we've seen and the reality that if you miss the opportunity or miss the high, the hardest sale, even if you're in my shoes, is when it's peaked and it's 20 cents lower, and you're still angry that you didn't sell the high, that you wait again, and then it goes another 20 cents lower. And then you don't own up to it for 6 months, and then you tell your wife, and then all hell breaks loose. No, I don't know. But that's the hardest decision in the world. So that's why I say have those orders in and use that volatility to get things priced. Is there, are we getting some background? Can you guys hear me if I just speak like this? Is that cool? We'll do soybean. Any questions on corn? Soybeans, even it's a harder market. As optimistic as I am on corn a little bit. I'm probably more of a bear on soybeans as far as just what we're into and the cycle that we're into, and a lot of it has to do with this year's carryout, 900 million bushel carryout. right? I think the previous high was 575 or something like that. So massive ending stocks. Okay, and in my mind, it's probably a 2-year cycle. I don't think you can fix it in one cycle. So this is something that's going to take some time. The acreage number helps. Okay, the acreage number helps. Whereas the corn number was higher than expected, the soybean acreage number was lower than expected. Okay, 84.6 million acres, down 4.6 million year on year. So big decrease year on year. Again, we were expecting some decrease, not 4.6. The average trade guess was 86.17, so 86.2 million basically. The Informa estimate was 85.5. Fed Ag Outlook number was 85 million. So obviously it was below all of those. And so that helped negate or neutralize a little bit of the reaction in corn. I believe soybeans on Friday closed down 4 or 5 cents. And again, were it not for the negative reaction in corn, beans probably would have closed up 7 or 8 cents. And we've seen beans come back, from then. So, but again, the bean acreage number did what it had to do. It's come down. It's come down a lot, come down aggressively. Your biggest decrease is projected to be in Iowa, down 600,000 acres. And then you have Minnesota down 500,000. So pretty consistent. The only state, we'll see Kansas up 200,000, but we're going to see, I think, and again, I'd be interested to get your opinion on some of this, if you see this much change in your area or your rotations or how you're analyzing the opportunity. But the one thing that confuses me or confounds me a little bit, again, is when you're looking at the cost to plant either corn or soybeans with where prices are, I didn't expect beans to drop this much, just based on the economics again. The S&D, absolutely, 100% have to do it. The economics, I would argue, don't really support this type of acreage decrease nationally, just based on the opportunity, corn versus beans, input costs, things like that. So we'll see. We'll see if that number doesn't go higher. I guess if I'm going to look at the S&D in soybeans, I have this number going up a little bit, whereas in corn I have it coming down. You can see the change here, March to January, just to gain some sort of, how accurate, again, is the March number. Over the last 10 years, we've had 6 increases, March to final, versus 4 decreases. The average increase, 1.44 million acres. The average decrease, 1.13. Okay? The biggest decrease we've had is about 2 million acres in 2015 versus a big increase in 2012. You got to throw that out, right? 3.3 million acres. So, again, a little bit more volatility. Why would that be? Obviously more weather dependent. If you don't get your corn plant or whatever, you get the switching to soybeans, things like that. That tends to influence this number and make it a little bit more volatile than the corn estimate. But 6 increases versus 4 decreases over the last 10 years. What's the S&D look like? If we're going to, again, build out an S&D for 1920 at 84.6 million acres, okay, using a 49.5 bushel per acre yield, okay, which again, the Feb Outlook estimate was 49.5, so the USDA gave us that number in February, which they would consider trend. Carrying stocks in 900. Your ending stocks number is 814, so stocks use ratio of 19.1%, still pretty big, okay, second highest ever. If acreage does go up, okay, to 85.6, so I took it up about 1 million. I also took the yield up a little bit, just based on the 3-year average yield being 50.9. I would not be surprised if in May the USDA starts with a number with a 5 in front of it. Same scenario, your stocks number jumps to 948, 22.3%. So, like I said, even with this acreage decline, okay, if we get a trend line or slightly above trend line yield, your carryout's still pretty big, right? So it doesn't say we can't rally. It just puts a cap on where the market can probably go this year. And ultimately, like I said, the only way to change this is to either have a yield aberration, 47, 48 bushel per acre yield, and or some increase in demand. And we're going to look at demand here specifically in a few slides. Here's the yield curve over the last several years. You can see 47.5, 48, certainly possible. We've been there in the last 5. 3-year average, though, of 50.9. Last year, again, statewide, if you're just looking at the entire nation, Illinois, record yield of 65 bushels per acre, almost unbelievable. Same thing in corn. But pretty good yields everywhere other than, a few states. South Dakota at 46, states like that. But definitely another good year for a lot of the big producers. But that's why I'm using a trend number closer to 50.9. Ending stocks, you can see this is just kind of the historical comparison. 574, that was the old record, 2006, 2007. So you can see where 900 gets us. Like that doesn't fit on the chart, right? It just stands out. So that's been the struggle. I mean, but I would say this, here's the beauty of the market, right? If you were just to take the carryout face value right now, should corn be over $9? You know, should it be above 8? We've been lower than 850, right, in the last 12 months. And yet here we have a market that's higher, right? And again, a lot of it's based on forward stuff. So the market tends to digest the greatest negatives that are already out there and then move on, you know, regardless of how negative they might appear. So the one thing I will say is that even if next year's carryout is still 800 million bushels, most traders, rather than looking at the pure number, they're going to look at the trend into the number. They're going to price the trend into the number. And why is that? Because you got a lot of East Coast money in the market, and they don't grasp all of that. So they're just looking at trends, percentages, things like that, and they're saying, hey, it's tighter than it was a year ago. We would say it's an 800 million bushel carryout, dude. Like, that's huge, right, still. But they would say, no, the trend is lower. So I think that's what creates this ability to take all the negativity, and even when it's still negative, start to correct the other way. And it's because the market's looking forward, moving on. We've priced that number in, and now where are we going from here? So keep that in mind as well. Stocks to use ratio, and this is pretty interesting. So 574 in 2006, 2007, that was about 18.6%, and we're at 21.9% today. So the 900 million seems like, you know, almost double, obviously, percentage-wise, what it was, you know, in 2006, 2007. From a stocks to use ratio perspective, because we're using so much, you know, more soybeans, it's not significantly higher. So what I would say there is if you can get the carryout back down to 550 or 600, you're going to see a much more price responsive market, again, to the upside, just because that stocks to use ratio percentage is going to be more consistent with not necessarily, you know, 10%, but probably closer to 15%, which, again, now we're probably playing ball a little bit as far as getting some rallies and some sustainable moves, hopefully above $10 again, you know, definitely in the back end. The key question, and this is the China speech here, you know, and we talked about that. It was on the postcard, so I want to address China. But they have exports going up next year, okay, to 2025. All right, this year they're at 1875 right now. All right, the previous year we were at 2129. So we've definitely had a significant impact because we've lost business to China. Okay, and there's just no doubt about it. Like a lot of times you read, we're selling more to the European Union, you know, places like that. You know, China accounts for about 65% of total world soybean imports. So, like, you just can't replace that. Like, you know, it doesn't matter if the European Union buys a couple more bushels. Like, it's not going to alter the effect or the influence of us losing business to China. So, my question is, you know, will we get the business back? Will that number come back? And if so, how much? My one problem is at 1875, and I'll show you guys this in a second. That seems high to me. That's wishful thinking at this point, okay? If you look at our actual sales pace and our shipment pace right now, we're still about 30% behind the previous year. That would suggest that number, that 1875, is still too high. So we'll have to see if we can hit that. Again, I think that's based on the assumption that we're going to carve out some major trade deal and that life's going to get better again. But we'll have to see if that happens. So this is the huge question mark moving forward. The other thing that was brought up during this whole experience is that, you know, we basically taught China, and again, in 2018, China bought about 66 to 68 million metric tons of soybeans from Brazil, okay? So they know how to buy from Brazil. Like, it's not like this is new to them. So their ability to just say, hey, U.S., you're going to mess with us or whatever, we're going to go to Brazil, we're going to buy some from Argentina, primarily Brazil, and we're just going to change how we do business, like, they can do that. And it could take us 1 or 2 or 3 years to get back what we've had. So again, that's my biggest concern, and that's why, you know, again, I think people will be hesitant before they embrace this idea that China's just going to rush right back and buy our soybean. What have we seen over the last 2 weeks? They typically buy beans when we're like sitting across the table from them. Like, and then they make this splashy buy, like 1 million metric tons, and then we don't see them for 30 or 60 days until we meet again. And what we need to have happen is that they come back and they're a consistent buyer. They're not a one-off buyer. The market wants to see consistent buys, and they don't want to have to see it made or happen because people are leveraging people over a potential trade deal. And that's what we have currently right now. So we need that to change longer term. But this is really, again, I would say the biggest unknown going forward for the soybean market. total soybean exports, just to give you some scope here. Brazil and Argentina now export about 85.8 million metric tons of soybeans a year. The U.S. at 51, okay? So they far surpassed us, or they've far surpassed us in terms of soybean exports. You can see that we've grown a little bit, and then we kind of stabilized and actually gone down. From a percentage base, okay, even as of 2016, Brazil and Argentina exported about 48% of the total world soybean exports. They're up to 56% now. We've gone from 40% to 33%. So we're going the other way, okay? And again, that's a trend that's not good for us. It's not good for us. So, and again, a lot of it has to do with China. If we get China back in, we probably get back up to 38%, 40%. But right now, this is what's happening, right? And this is a major influence on our ending stocks numbers. So not only did we have a great yield again last year, we had record acreage, record production, things like that. We also lost our biggest customer. And it's the combination of those two forces right now that are really, I wouldn't say depressing the market, but putting a cap on it, putting a low cap, a low ceiling on the opportunity. So something to consider. Top world soybean importers, I alluded to it already. You've got China in 2017 at 94.1 million metric tons. This year, they're also importing less. They're at 88, but they're 70% of the world market. The next largest importer, like number 2, is the European Union at 15.8 million metric tons. So you've got 88 from China. Second is the EU, and this is funny to me because like Trump tweeted this out too. He's like, "This is like 6," and this is not a political statement. This is just Trump saying, "Oh, we lost China, but we got European Union," and I'm like, "You're right. That's great. 15.8. I mean, like it's not even comparable. You just can't lose that market." So this just shows you how important getting that back is longer term. Here's kind of the tariff timeline if you just want to look at it. In 2017-18, so we've been about a 2 billion bushel exporter of soybeans. We exported about 1.25 billion bushels to China that year. So about 60%, okay? This year, or in 2018, again, you kind of got the calendar year and the crop year here that overlap, but we had the 25% tariff on July 6th. In November, China didn't import 1 bushel from the U.S., okay? It never happened, like 25 years. I mean, this is unheard of. Meanwhile, Brazil more than doubled their exports to China the same month, okay? For the calendar year in 2018, we exported 16.6 million metric tons. That's down 49% from the previous year. And again, most of that was done during the first half of the year when we didn't have the tariff, right? So basically half of what we normally do. Meanwhile, China imported 66 million metric tons from Brazil, so up 30%. So we're starting to see that shift, and that's what I'm talking about. Will we get it back? We'll see. Now, I will say during the month of February, China finally started taking some U.S. soybeans again. This was because of the negotiations made in December and January. Okay, still substantially less, though, than the prior year. And then just this week, I posted one. We're starting to see private exporters announce sales, not shipments. I think there's a difference there, too. That scares me. You can cancel a sale. When it ships and arrives, then you know it actually got there. They like to cancel sales as well. But we made a sale of 828,000 metric tons. We've had some other sales of 1 million. All these have been coming out the last couple of days. So it looks, at least on the surface, that it's improving. But as I said, for the current crop year right now, we're 30% below the previous year. Okay, so what's been actually physically shipped, we're 30% behind a year ago. If that's the pace, okay, and that we sustain this and it doesn't improve the second half of the marketing year, which I don't think it will, what's the challenge now? What would be the challenge now if we want to sell more to China? Who's just harvesting right now? Brazil's harvesting right now. So they're just replenishing. They're about 70% harvested. So typically the U.S. dominates the world soybean market in Q4 and Jan and Feb. Okay, and then it transitions to Brazil. And so this is the wrong time of the year to try and catch up. So again, that 1875 for 1819, I think that number is going to come down over time. And then as of this morning, I've been in here an hour. I don't know, something could have come out, but it's, trade deal's imminent. We hear this every week. But the one that hurt the market again a week ago, and this is what happens, is you get an announcement that a trade deal's close, and then Trump mentioned that they might keep some of the tariffs in place to make sure that they're following through. Well, then what is China? You know what I mean? So it's like you don't know when it's going to end. So that's kind of the state of the union, if you will, on the China-U.S. trade deal from what I've seen. And again, like I said, it evolves and it changes by the day. But that's what we know today. Again, it's super important, from where I stand, that there's a deal. And again, if you're a trader and you're trading money, there's nothing worse than political influence screwing up what you perceive to be normal trading economics, supply and demand, technicals. You can trade those things. You can't trade political stuff. Like, it's too hard. It changes too much. And so anytime that happens, money comes out of the market and they're going to go put it somewhere else. And again, it takes money to create opportunity. So without the money, you're going to have narrow trading ranges, okay, and just less opportunity. So that's kind of how I see this right now. November soybean chart, okay, and again, really, there is no analog year because of where the stocks are. I would just say that the high, if you go back to 2018 in November 2019 soybean futures, 1010. So if you're saying, okay, what's my opportunity? 970, okay, it's kind of been the high since December. When you see the tariff move, in June, you can see it on the far left-hand side. We collapsed to 864 3/4. We've come back now, but really 970 has been a stopper. We did have the break to 918 on the day of the intentions or prospective plannings report. That coincides again with kind of that 910 move in November. So you're kind of, like I said, it feels like you're at the lower end of a range. I would love to see the market close back over the 200-day. The 200-day and the 100-day, typically, guys, are big momentum indicators for the market. Like, if you close above or below it for normally 2 or 3 sessions, that's when that momentum flips. A one-day deal doesn't hurt you so much, but if it's 2 or 3 sessions, that's when the money will start to flip, and you'll trigger liquidation either up or down based on where the paper is. So I'd like to see that continue. But right now, I think you're kind of in a 910 to 970 market. And like I said, if I got a chance today, I've been a seller above 960 to 970 on about 25% of my position. I'm okay with that. If I get back up there, I'll probably sell a little bit more. And the reason is I'm just being realistic about the stock situation, about where acreage is, about yield. If the weather changes and we see some adversity there, and or we see a deal out of China, maybe I'll change my opinion. The one thing I will say is the reality of China making a deal with us, it's at the wrong time of the year. So what you're going to get probably is this 20, 30 cent move, and then you close unchanged, right? Because we're all excited, and then we're waiting for that buy, and then we're waiting for that buy, and we're waiting for that buy, right? And it just doesn't follow up. So use that. What I would say is use that volatility, that opportunity, if you do see an announcement or whatever, to not get bullish at 960, but to maybe say, hey, I should probably take some off the board. And the other thing I get is, Mark, that's below my break-even, Marcus. Well, so is $9, And so the reality is you got to kind of trade the market 1 or 2 times in this type of market. That's how I trade it. And that means buying or selling your position and maybe buying it back and then selling it again. And if you're within a 80-cent range in soybeans and the range in corn is 40 cents until you get to July, then you trade that window, and you do the best you can within that to create additional opportunities, unless it's a hedge you can live with, you know what I mean, and just go to the bank on it. So that's kind of what I see out of November. The money in soybeans, they're also negative. I can understand why a little bit more so. They're short about 50,000 contracts, so they don't have quite the exposure that they do in corn right now. We have been lower. And again, it's not different than you tend to see a rally. You tend to see them get long. I will say in 2015, the longest they got, about 85,000 contracts. So they don't have to get super long in the summer, whereas in corn, they typically go long 200 to 250,000 contracts, which creates more of a move. So again, I don't think they're overly vulnerable. My point would be to the market taking off to them on the upside. They're probably more comfortable here being short in soybeans, even at 50,000 contracts net short, than they are in corn, if you will. So that's where the money is there. And finally, the 5-year seasonal, more volatility. More volatility. Corn's pretty seasonal. Like corn, you can pretty well pick June, July, whatever. Beans, it's a little bit all over the place. But the 5-year, again, not surprising that we saw a correction around March 29th, March 28th. Sideways to lower through April 15th, higher into the 3rd week of May. And then, again, you can rally back, you can create new highs. It's a little bit all over. But this would also say that the highs that you had earlier in the year aren't necessarily, from a 5-year perspective, eclipsed in April, May, and June. You know what I mean? So use that 10-10 from March of 2018 as kind of a top side price objective, if you will. And again, that's a lot of things have to go right for us to get up there, and I doubt it closes up there, but you can use that as an objective. So that being said, that's kind of where beans are at. So some challenges there as well. Like I said, keep watching the China event, and then really it's on to crop condition reports and weekly crop progress. And you know, the next thing you're going to hear about is the rain and the flood water and delayed planting. And you guys know delayed planting doesn't have what it used to have in terms of you plant everything in a week, right? So you screw it up for us. Like we liked it delayed once in a while. That doesn't happen anymore. So unfortunately, that's not as bullish as it used to be, but hopefully it creates some volatility and some opportunities. So we send a wire out every week to these guys as well. I think it's on the website and can certainly, help on a need-to basis. So.
Yep, it's the dirt. It's on our website. As Brett alluded to earlier, we're trying this where we spread the marketing meetings out throughout the year. So we want you guys to get something out of this. So hopefully it's providing useful information. If there's something else you'd like us to cover or go over or do something different, please get in touch with us. We'd be happy to consider anything, I guess. So again, thank you for coming. Give us a call. You guys probably saw this year we had pretty wide basis differences in locations. So maybe it's not the location that you normally deliver to. But we may have a better basis somewhere else. Give us a call. We'd be happy to discuss that with you. And get your target orders in as well. All right, thanks for coming, guys.